You see a headline about a startup that keeps losing money, and somehow the founders are getting richer. Then you hear investors talk about vision and growth like it's holy. Meanwhile, you are paying your bills with your real salary, and you are told that losses mean failure. The paradox feels like a scam because it is. But the deeper truth is harsher than you think. Most people are not confused. They are participating without realizing what role they are playing. Welcome to the hidden self. Today we are decoding a valuation magic trick that runs through modern finance like a hidden bloodstream. It's not just about electric cars or food delivery apps or flashy AI dashboards. It's about how value gets manufactured when reality is no longer the scoreboard. It's about how money turns into a story and how the people closest to the story quietly skim the profits while the rest of society absorbs the risk. If you've ever felt manipulated by systems you can't fully name, this video is going to give you the name. And if you have ever defended your own suffering with the phrase, "That's just how business works," you may feel attacked. Good, that means you're finally awake. Here's the setup. You have been trained to believe in a single economic law. If you lose money, you are failing. That law is true in the world of real profit and real survival. It works for the family workshop, the corner cafe, the online store selling actual products with actual margins. In that world, if your costs exceed your revenue for too long, you go out of business. That is not morality, it's physics. But the modern finance game you're watching does not run on physics. It runs on valuation, it runs on narratives, it runs on expectations about the future that can be traded today. And this is where the illusion becomes powerful. The companies you see losing hundreds of millions, sometimes tens of billions, are not necessarily designed to become profitable. Many of them are designed to become assets, not products, assets. Like land that appreciates because people believe it will become more valuable, like a stock chart that rises because enough people are willing to pay higher prices than yesterday. In other words, they are not building only businesses, they are building a pipeline that transfers wealth from one group to another. Now let's go deeper, because the loss paradox is only the surface layer. Under it is a psychological machine. Under it is a social ritual. Under it is a way elites protect themselves while asking everyone else to take the emotional and financial damage. Section 1. The product is not the product. The story is. Most people see a company and focus on what it sells. They judge quality, they judge convenience, they judge whether the car is good, whether the app is useful, whether the food arrives fast, whether the user experience feels smooth. All of that is understandable. It's also a distraction. The uncomfortable truth is that many of these companies are not trying to win customers the way you and I would. They are trying to win investors, and investors do not buy only outcomes. Investors buy permission. Permission to keep funding a future vision. Permission to believe that other people will pay higher prices later. Think about it. When you buy a loaf of bread, you care whether it tastes good today. When you buy a share of a startup, you care whether someone else will pay more tomorrow. That difference is where the trap lives. Imagine a founder standing in front of an investor deck. The founder doesn't say, "We are selling a car that loses money." The founder says, "We are selling a future where we dominate the market." Notice the grammar. One sentence describes a product. The other sentence describes a world. In this valuation economy, a loss is not evidence against the story. A loss can be evidence for the story. Loss can be reframed as investment. Loss can be framed as market penetration. Loss can be framed as competitive pressure. Loss becomes a prop. Let me give you a micro story. Picture a small investor sitting in a cafe scrolling through their phone. They see a clip of an electric vehicle brand. The car looks clean. The sound is polished. The factory footage is dramatic. The founder smiles like a tech saint. And the captions say, "We are reinvesting everything into growth." This investor feels reassured because the phrase reinvesting sounds virtuous. It tells them the founder is not greedy. It tells them the founder is patient. But behind the scenes, the investor's money is being used to subsidize the consumer and crush competitors that can't afford to play the same game. The investor believes they bought innovation. In reality, they bought the belief that the winner will be declared later. They bought a lottery ticket that someone else is managing. Now flip it. Imagine you and me opening a cafe. We lose money for a year. People say, you must be doing something wrong. If we lose money for 3 years, people say, it's not scalable. They judge our product, our pricing, our management. They don't call it reinvesting, they call it weakness. Why does society apply different rules to small operators and to financial giants? Because the giants are protected by language. They have marketing teams, PR narratives, and investor ecosystems that turn losses into symbols of ambition. The small operators don't have that protection. They have only numbers and receipts. This is not an accident. It's a system of selective credibility. And it shapes your emotional reflexes too. You are trained to trust the tone of sophistication and dismiss the quiet truth of profit. Here's another uncomfortable layer. When you hear about a company burning cash, the word burning almost makes it sound like fire is consuming money for a noble cause. But in many cases, the cash burn is not a side effect. It's the mechanism. In a real economy, cost must lead to value. In a valuation economy, cost must lead to momentum. If investors believe momentum is growing, they accept the costs as the price of acceleration. They don't demand immediate returns. They demand visible signals that the story is working. User counts, market expansion, partner announcements, brand dominance metrics, and sometimes even carefully engineered data. This is how a company can be clinically unprofitable, yet emotionally profitable to the people selling it. The product is often just the costume. The story is the transaction. And the reason you feel uncomfortable is because your moral intuition is still alive. You still know that something is off when suffering is rewarded and losses are celebrated. Your hidden self is sensing the mismatch between reality and reward. Good. Don't anesthetize it. Section 2. The valuation game is a separate planet where the balance sheet is not the scoreboard. Most people think the economy is one thing. It's not. There are at least two economies operating side by side. One is the economy of usage, the world where you work, earn, pay, and survive. The world where margins matter and where competition forces efficiency. If you run a business and you can't make profit, you can't keep doors open forever. The other is the economy of valuation. This economy is driven by expectations about the future, and it is fueled by money that is cheap, plentiful, and willing to postpone reality. In this world, the key question is not, do they make money? The key question is, can they persuade the next round that they will make money later, at a higher scale, at a higher price? Here is the core formula, spoken plainly. Your share price is not a receipt, it is a crowd belief. It is a prediction someone is willing to pay for today. So when you see a company lose money, you should not immediately assume that valuation will collapse. Valuation can rise even faster than the losses accumulate. Why? Because the crowd is not buying present performance, the crowd is buying future narrative. Now let's walk through the funding rounds like a ritual. First comes the seed stage. A founder has an idea and maybe a prototype. The company is barely alive, revenue is small or non-existent, the product might be broken, customer acquisition might be a fantasy, yet investors step in because the idea is a seed for a bigger story. In the early stage, valuations are often based on what percentage of future dominance they think they are buying. Suppose an investor puts in $1 million for 20%. That gives a valuation of $5 million on paper. The company still loses $1 million. But the investor's calculation is not, we lost money. The investor's calculation is, we bought a fraction of a company that will be worth more if the story succeeds. Second comes the next round. Maybe the company shows a prototype now works better. Maybe they have user growth metrics, even if the revenue doesn't cover costs. Maybe they announce partnerships, expand into new regions, or report progress that looks like momentum. A venture capital fund invests $20 million and asks for 20% again. But notice the trick. The valuation might jump from $5 million to $100 million, not because profitability improved, but because the story got stronger and the market got warmer. The earlier investor who paid $1 million for 20% now holds something paper valued at $20 million. They didn't receive a profit as cash, they received a paper gain. That paper gain is powerful because it becomes leverage, it becomes confidence, it becomes a selling point for future investors. Third comes the later rounds, where the company keeps losing more, but each round can increase valuation if the narrative remains intact. The more money is poured, the more subsidies can be used. Subsidies help growth. Growth helps the story brings more investors. The cycle repeats. This is where people get emotionally confused. You and I were taught that performance must come first, but in valuation, persuasion comes first. Performance is optional at early stages. The proof can be delayed. What matters is that the next buyer believes the story enough to pay more. And what happens when the valuations are rising while the company is losing? For founders and early investors, the answer is simple. Wealth creation through ownership changes, not through profit. They become rich when their shares become expensive, even if the company has not made a penny, and they can become rich before the company ever earns. This is the part that makes most viewers angry because it violates fairness. You are thinking, if nobody is making money, how can someone get rich? The answer is that money is changing hands somewhere else. It's not coming from the product's profit, it's coming from the next round's investment. The company's losses are not the investor's only story. The losses are the cost of maintaining momentum long enough to justify higher prices. If you still feel a tight knot in your chest when you hear this, that's your moral sense detecting something true. It's not jealousy, it's pattern recognition. Your mind is realizing that the reward system doesn't reflect reality for you, but does reflect reality for them. Let's go further. The bigger the valuation, the less the founder needs the company to be profitable in the moment. Their financial life is already secured on paper, so the company can keep burning cash without threatening them. The burden moves outward to the investors who arrive later, and ultimately to the public. This is how risk gets socialized and profits get privatized. And here's a darker point. Even the word loss becomes misleading. Losses do not just mean waste. In this system, losses can be purposeful spending designed to weaken competitors, buy market share, and create a dominant position that later allows pricing power. Sometimes that dominance is real. Sometimes it's a fantasy held alive by continued capital inflows. Either way, the valuation machine doesn't care as much about truth as it cares about belief. You are not wrong for feeling that belief is being manufactured. Section 3. The war logic, why cash burn functions like a weapon. Now you might ask, if this system is so effective, why do they lose so much? Why don't they sell at break even? Why not keep unit economics clean? Because in valuation logic, the goal is not to be best. The goal is to be first, big enough, and dominant enough that competitors cannot survive. This is not a marketing slogan. It's a strategy of attrition. Imagine a battlefield where ammunition is paid for by investors. Now imagine a smaller army that has to fight using its own earnings. In a real economy, that smaller army would die quickly. It can't fund long campaigns. But in valuation economy, the larger army can keep firing because the ammunition is coming from cheap capital, so subsidies are used. For an app, subsidies might mean discounts to riders or restaurants. For a ride-hailing market, it could mean drivers get paid more while passengers pay less. For electric vehicles, it could mean selling below cost while spending heavily on infrastructure, marketing, and consumer incentives. Look at the math with cold eyes. Let's say each ride loses $15 per trip. You and I would call it losing money. But in the war logic, those losses are not the failure. They are the cost of pushing competitors out of the market long enough for dominance to solidify. This is a key psychological inversion. People hear losses and think they're losing. But in this system, losses can mean they're winning the war of resources. The objective is to exhaust competitors that cannot raise as much capital. If your opponent has no oxygen, your spending becomes their death. When they run out of cash, they stop offering service, stop hiring, stop marketing, and eventually vanish. The surviving platform can later raise prices, cut subsidies, and look profitable. So yes, there can be a strategy underneath the chaos. But even when the strategy is real, the distribution of benefits remains skewed. The winners are not the people who suffered the losses the longest. The winners are the people who got out first, either through share sales during later stages or through the IPO. Let's make this personal with a micro story. Have you ever had a boss who pushed your team to work overtime during crunch time, but when the project succeeded, your boss took the credit and you got the fatigue? You felt powerless because you did not control the exit. You were building while someone else planned to leave with the payoff. This is what attrition capitalism feels like to the public. The public is the labor of belief. The public is the ongoing buyer of the narrative. The public is the one who pays through risk exposure, through stock purchases at high valuations, through pension investments that will later be managed with headlines instead of honesty. Now consider the moment when the subsidies stop. When the platform becomes dominant, it can reduce discounts. It can raise fees. It can justify pricing with market conditions. If you look closely, the same story shifts. Early, the story is about growth. Later, the story becomes about efficiency. The language changes to match the phase of capital harvesting. This is another way the system protects itself emotionally. It makes you forget the earlier losses because it changes the story at the right time. And you might be thinking, isn't that still capitalism? Isn't that competition? Yes, it's competition, but it's competition with asymmetric funding. It's competition where money can outrun productivity. It's competition where capital markets can override the normal consequences of losing. That is why small businesses lose even if their product is genuinely better. A small cafe cannot subsidize every customer for years and still pay rent. It cannot create artificial demand funded by venture money. It cannot survive long enough for dominance to emerge. The war logic does not care about how good your espresso tastes. It cares about cash. If you don't understand this, you blame yourself when you fail. You think, I must not be good enough. Sometimes you aren't, but often you are simply outgunned. And the system is designed to keep you blaming yourself rather than questioning the rules. That self-blame is one of the hidden self's favorite tools. It keeps you obedient. It keeps you competing in the wrong arena. Section 4. The exit. The legal theater where future profits are sold to the public. At some point, this machine must stop. Shares on paper don't pay rent forever. There has to be an exit. There has to be liquidity. If early investors keep waiting, the bubble eventually pops. The story must be cashed out. The grand legal exit is the IPO, initial public offering. It sounds like a milestone, like a victory. It is often a moment of celebration. Yet from the perspective of those who already own a lot early, it can be a final harvest. Here is the uncomfortable truth. At IPO time, the company may still be losing money heavily. The product may still not be profitable at scale, but the stock becomes tradable. That means existing shareholders can sell. Not all of them immediately. Sometimes there are lockup periods, but eventually the sell down happens. Who buys the shares? Not the original investors, not only. The buyers include the public. It includes pension funds, retail investors, and anyone attracted by the narrative that they are investing in the future. It includes people who want to believe they are smart enough to ride the next wave, and that's the psychological hinge. Public investors do not just buy a company, they buy a feeling, they buy the relief of not missing out, they buy the identity of being modern and brave, they buy the fantasy that the future belongs to them. Meanwhile, earlier investors and founders are already playing a different game. Their shares were purchased when the valuation was low. Now the valuation is high. Their percentage of ownership at IPO is converted into wealth that can